What's going on, everyone? In this video, I'll be going over how to identify and trade the TGIF setup. This is something I've been trading for over a year now, and I can say it's one of my favorites because of how simple and effective it is. My goal is that by the end of this video that you'll not only understand the concept, but also be able to translate it into a real actionable setup, since at the end of the day, that's what actually matters. Also, really quickly, I'll mention if you want to follow along this video with visuals, I'll have a resource link down below in the description from my Twitter, which has a bunch of organized images on this topic. For those who aren't already familiar, I'm going to be answering the question of what actually is TGIF and how does it look on a chart. On the left here, you can see what's representing one bullish weekly expansion candle. The candle opens, makes a move below the opening price, forming a low, and expands off that price point into the high. And from the high to the closing price, this downside move here is what we consider a bearish TGIF. Same idea here on the right, we have what's representing a bearish weekly expansion candle. The candle opens up, makes a move above the opening price, forming a high, and then expands to the downside off that price point into the low. The range from the low to the closing price, which forms the wick, is what's considered a bullish TGIF. To get an even better view of this price action tendency, we can break that one weekly candle down into a daily chart. On the bullish example, price opens up, drops below the opening price, forming a low, expands through the midweek, creates a local high, and then on Friday returns back into that weekly range, forming this wick that we see here. Same exact idea on this bearish candle. Price opens up, creates a high of the week, expands through the midweek, forms a low, and then on Friday returns back into that weekly range and forms that wick here. Now that you understand the basics of this concept, I'm going to be answering the question of when does TGIF actually occur. One of the main misconceptions that I see a lot is that this is something that occurs every week, and that is simply not the case, at least in the form of a high probability setup. Here on a weekly chart, it's pretty easy to see that many of these candles, or the majority of them, have wicks to either end, but that does not automatically mean that there's a TGIF setup in play. Understanding the daily fractal within these weekly candles is what's going to give us the outline for when a TGIF is likely to occur. Here we're going to be going over the 3 criteria that must be met in order for a TGIF setup to be anticipated. Number 1, in a bullish week, a low must be formed on either Monday or Tuesday, and in a bearish week, a high must be formed on either Monday or Tuesday. Using the understanding of how weekly profiles work, if a reversal point for the week is formed on Wednesday or Thursday and not Monday or Tuesday, that's going to make Friday a low probability condition for it to return back into the range. If you're unfamiliar with weekly profiles, I'll leave a link down below for a resource which has everything you need to know on that topic. The second criteria that must be met is from the point of the reversal, price must expand through Thursday. Here on this bullish example, a low is formed on either Monday or Tuesday and expands to the upside through Thursday. And same for the bearish example, a high is formed on either Monday or Tuesday and price expands to the downside through Thursday. The third and final criteria for the setup is that price achieves a weekly higher time frame objective. On a bullish expansion week, we want to see price achieve a premium array, and on a bearish expansion week, we want to see price achieve a discount array. You want to be seeking higher time frame objectives on any chart 4 hour and above. Now that you understand the concept of TGIF and when it's likely to occur using the 3-step process, we can move into a real chart example. Going back to the 3 criteria as previously mentioned, we can start with asking the question of what day did price reverse. Here on this chart, we can see price reversed and made a low on Tuesday, so we can check that box off. Number 2 is, did price expand through Thursday? From the point of reversal on Tuesday, we can see Wednesday and Thursday were expansive with higher time frame displacement and clear directional order flow. The third and final question is, did price achieve a higher time frame objective? The answer is yes. On Thursday, price reached into the external range high. That is a premium array on a higher time frame. With all 3 of those boxes checked, we can assume an anticipation for Friday to return back into the range, as we can see here. As a general profit target for the TGIF setup, we want to see price retrace 20 to 30% back into the weekly range. Marking out the low of the week to the high of the week, we can anchor a fib tool to those 2 price points and see how the market retraces back into that range of 20 to 30%. I'm not a big fan of talking about moves that I didn't trade, so here you can see a pop-up on the screen of my executions for the setup. The final detail for the setup is understanding the relationship between Thursday and Friday's price action as it sets the framework for the TGIF counter trend. The first scenario you can encounter is a sweep of Thursday's high or low depending on the context. Here this is a bullish week, so we see a sweep of Thursday's high, and then that's when price returns back into the range. The second type of framework is price can retrace to an internal PD array such as a fair value gap or order block and can counter trend off that price point. On the screen now, you can see an outline of these two frameworks. You also have the option to use SMT as a confluence tool when the market offers it. If you happen to want more resources on this topic, all links will be down below. And if you enjoyed this video or found it helpful, please let me know in the comments, and we'll see you in the next one.